Wondering about the Bank of Canada's upcoming rate decision on March the 12th and how this matters to you? Whether you're buying your first home, refinancing your mortgage, or just trying to figure out why interest rates seem to change like the weather, stick around. This video is packed with insights that could help you understand what's affecting your wallet right now. Plus, we'll talk about how recent US tariffs might shake things up. So let's dive in. Alright, let's get straight to the point. On March 12th, the Bank of Canada will announce its policy rate decision. This is important because it directly impacts borrowing costs across the country, from mortgages to car loans to credit cards. But here's the kicker, it's not random. The Bank of Canada looks at key financial metrics like inflation, GDP growth, unemployment, and even global trade conditions before making their call. And today, we are breaking down exactly what those factors are and how they might influence the decision. Alright, let's start with inflation. The big boss in this whole equation. Inflation is basically how much prices are rising for stuff we buy every day. Groceries, gas, rent, you name it. The Bank of Canada has one main goal here. Keep inflation close to 2%. They tweak rates to hit that sweet spot. Too high inflation means your money buys less avocado toast. Too low means a sluggish economy. Right now, inflation has been hovering near that sweet spot after years of ups and downs. But here's the catch. There are still some sticky price pressures out there, like energy costs and housing expenses. If inflation starts creeping higher again, the bank might feel pressured to raise rates to cool things down. To clearly illustrate this point, let's look at this graph. It shows the correlation between inflation and policy rates over time. When inflation trends upward, bam, policy rates quickly follow suit. A close look at the graph shows a slight increase in the inflation number between December 2024 and January 25. Under normal circumstances, aka sans Trump tariffs, this would indicate a possible pause on BOC's side for the next rate announcement. If prices start rising faster after March the 12th, don't be surprised if borrowing costs go up too. Next up is GDP growth, a fancy term for how much Canada's economy is producing overall. Think of it as the economy's pulse. When GDP growth is strong and steady, life is good. But if it slows down or contracts, well, that's when things get tricky. As evident in this graph, there is the negative correlation here. When GDP growth slows down, like during recessions, the bank tends to lower policy rates to encourage spending and investment. Double-clicking on the recent GDP numbers, we can see that there has been a recent uptick in the last 3 quarters, with GDP increasing from 1.9% in Q3 of 2024 to 2.4% in Q4 of 2024. This indicates growth in Canada is recovering steadily, but still modest at about 2.4%, and signals that the economy is stagnating, suggesting that the bank might hold steady. Alright, now let's talk about unemployment, the metric that hits closest to home for many Canadians. High unemployment means fewer people have jobs and money to spend. That's bad news for the economy, and for you if you're trying to sell a house. Canada's unemployment rate is currently stuck at around 6.6%, and recently only 1,100 jobs were added. Here we see the unemployment rate and its relation with policy rates. And surprise, there's a negative correlation here too. Higher unemployment usually leads to lower policy rates because the bank wants to stimulate job creation by making borrowing cheaper. The current unemployment rate remains elevated at around 6.6%. However, the graph indicates a recent gradual downward trend, suggesting the job market is stabilizing at these elevated levels. This provides the bank with room to hold rates steady while adopting a wait-and-see approach. And now for the wildcards, external factors like US tariffs and commodity prices. These are especially important right now because Canada relies heavily on exports like oil, natural gas, and minerals, and especially to the United States. Here's what's been happening recently. The US has proposed new tariffs on certain Canadian goods as part of broader trade policy changes. This could weaken demand for Canadian exports and slow economic growth here at home. And then there are commodity prices, another big player in Canada's economy. If oil prices drop unexpectedly or global demand weakens, it could push the Bank of Canada toward keeping rates low to stabilize things. Alright folks, enough of the data. It's prediction time. Based on everything we talked about, inflation near target but still sticky in some areas, GDP growth recovering but modest, and unemployment staying stubbornly high, it looks like the bank might hold steady during their March 12th announcement. But remember those external factors that we talked about, and especially that trump card, i.e. US tariffs? They're going to add extra pressure on the Bank of Canada to lean toward caution and support businesses and consumers facing the uncertainties of the tariff war. This essentially means that rates are heading down again by 0.25%. But given the market's forecasted impact on the economy, we could very well see another jumbo rate cut of 50 basis points or 0.5%. So what does all this mean if you're looking to buy a home or refinance? Well, it means timing matters. Lower policy rates often lead to lower mortgage rates, which means more affordable monthly payments for you. If you're wondering how these changes affect your specific situation or want personalized advice on locking in the best mortgage rate, click the link below to connect with our trusted mortgage broker partners. And that's it for today's episode. If you found this helpful and want more insider tips on navigating Canada's housing market, consider subscribing. And don't forget to like and hit that notification bell. Drop your questions in the comments below. I'd love to hear from you. Until next time.